First, we have to understand what is capital employed. Capital employed, basically, this is the money invested into the business for operations. Okay, for operations, to make investments and to make more profit. Okay, that is capital employed. All right. Yes. Capital employed, how we get it on the balance sheet? Remember, from the accounting equation, assets equals liabilities plus capital. We break our assets down into assets. We break them down into the non-current assets, NCA, plus current assets. Liabilities also, we break them down into current liabilities and non-current. Non-current liabilities, NCL, plus current liabilities, okay, plus equity, okay. So what we are just basically doing here is the non-current assets, the current liabilities. Current liabilities, take them over the equal sign where the assets are. Okay, so basically, non-current assets plus current assets, total assets. Assets minus current liabilities equals non-current assets plus equity. Non-current liabilities plus equity. Okay. So this is long-term financing. Okay. Non-current liabilities, these are long-term loans. Okay. Equity, this is the money you are raising from shareholders. Okay. So there's equity and debt financing. Okay. So when you combine this financing from non-current liabilities and equity, this is what is your capital employed. Okay. When you sell your shares, you make your share capital. When you get your debt, you have your total debt, which is your non-current liabilities. You combine this money, that's your capital employed. Because this money, you're going to use it for investing into the business, getting new machineries, opening a new factory, okay, buying new equipment, okay, purchasing more inventory, okay, buying new assets for the business. Okay, that's what this money is used for. So now, the return on capital employed is telling us this money which we have invested as capital employed, this capital which we've invested in the business, how much return are we getting back? Okay. So, the return on capital employed, this is the formula, ROCE, because your profit before interest and taxes, operating profit, over the capital employed. Times 100%. So again, we have to remember we have to see the mechanics of this ratio. Okay. If we look at the relationship between the return on capital employed, if the operating profit, which is profit before interest and taxes, if let's say it's if we ignore, the change is negligible, okay, we hold it constant, what's going to happen is the return on capital employed and the capital employed, they are going to have an inverse relationship, meaning the more capital you put into the business, your returns are going to start dropping down for that capital. Okay? Which is also called overcapitalization, colleagues. When you get so much capital, new machinery, new vehicles, new equipment, and then you find that it's not being used. It's just sitting there at the office. Okay. Yes. So basically, what this ratio is telling us is that as you put in this capital employed, okay, your returns has to increase. Your operating profit has to grow too. Okay. It has to grow too. So if we look at the relationship between the return on capital employed and if capital employed drops, it means this return is going to go up. Okay. Especially, let's say, for example, if you're paying off your non-current liabilities, that is reducing your capital employed. Okay. You're paying off your debts. Okay. This is helping your profitability because you're not having too much tied up in debts. As you pay off the debts, you start having more free money which you can use for other things. Okay. Then if you look at the relationship between the operating profit and the return on capital employed, these two have a positive relationship. If capital employed, the change is negligible or doesn't even change at all. Okay. If your operating profit grows, you can also expect your return on capital employed to grow. Okay. Because remember, this money that you're investing in is for the operations for the business. So if these operations are generating you more profit, then that's a good thing. Okay. So if you say a return of capital employed of 30%, it means for every one kwacha you've invested as capital employed, every one kwacha that you've invested, capital employed, 30% is coming back as operating profit, or 30 ngwe. 30% of one kwacha, 30 ngwe is coming back as operating profit. Okay. If you put in 100 kwacha, your return is 30 kwacha. Your operating profit is 30 kwacha. Invest 100 kwacha, the profit you're getting back is 30 kwacha. If it's 1,000, 30% of 1,000, you're getting back 300 as operating profit. Okay. Yes. So for every, just telling us how much, what our profit, the profit we are getting for every one kwacha we invest as capital